Hi, I'm Hashim Kutsi, co-founder of Liwa Capital Advisors. I would like to share with you what I know about inflation-linked bonds, as I think they have an important place in today's world and in your portfolio. My experience with inflation-linked bonds goes back to 1997, right around the time the US Treasury started to consider issuing inflation-linked bonds. I witnessed 30-year US inflation-linked bonds trading around 4.3% real yield around March 2000, which was the peak and coincided with the stock market peak back then. With not much volatility in inflation since 2000 versus the previous decades, inflation-linked bonds have not gotten much attention. However, now with the printing of money and zero interest rates, inflation has come back to focus. Inflation-linked bonds are the only instruments to effectively protect against inflation. Here is why. Inflation-linked bonds pay a fixed real yield plus the ongoing actual accrued inflation rate. This eliminates concerns about the return on the investments after inflation. This is different from the typical nominal bond that has a fixed yield embedded in it, meaning an inflation expectation has already been fixed for the life of the bond. The investor has to carry the risk that inflation will turn out higher than what was expected when the bond was issued. Naturally, this makes inflation-linked bonds less risky and a separate investment and asset class given their different behavior. The performance difference between a nominal bond and an inflation-linked bond depends on the difference between actual inflation and what was expected. Higher inflation than was discounted makes the performance of inflation-linked bonds superior to nominal bonds, all else being equal. By the same token, if inflation turns out to be lower than expected, then nominal bonds will perform better. So in today's world, with the printing of money to finance government spending and grow the economy when interest rates are at zero, there is a good reason to be concerned about what the inflation rate will be in the future. With inflation-linked bonds, that issue is resolved, as investors will earn the current real yield plus whatever inflation turns out to be. In a portfolio context, inflation-linked bonds provide a diversification benefit as they're not exposed to inflation. They can also appreciate in value more than nominal bonds in a zero-rate environment, given that the inflation-paying feature puts no floor for their yield below zero, whereas nominal bonds have a limit on how far below zero yields can trade. Historically, real short rates have traded as low as -10. So with zero to negative real yields on these bonds, one might ask, why should I own a negative yielding instrument? While the real yield on the US 10-year inflation-linked bond is approximately around -1%, and the current inflation in the neighborhood of 1.6, netting a positive 0.6, the investor at least has the inflation factor covered, protecting the real purchasing power of their capital. Other investments might not provide that protection after inflation. The inflation-linked bond market is very liquid, with a large menu of offerings across the globe. The US is the most liquid, followed by the UK, which started issuing these bonds back in 1981. So in summary, the protection from inflation and the diversification benefit that inflation-linked bonds offer are the main attributes that I wanted to share with you.